Hey guys, today we are going to talk about a topic that is highly misunderstood or overly complicated, which is refinancing. And when it comes to the world of real estate investing, it's one of the most important things that you can do in order to either start your real estate investing journey or to continue to grow your portfolio. And so I wanted to take you through a couple of examples, some of the benefits, and just really how the whole concept works. Usually when it comes to real estate, you'll buy a property and say you held it for 10 years. A lot of the times, especially in today's environment, that real estate will have gone up in value. It's appreciating at anywhere from 5, 7, 10% a year. And after 5, 6 years, you've got a lot of equity built up in that property, which is capital that's not currently available to you. And so say you paid $500,000 for a house, it might be worth $600,000, $700,000, $800,000. That money is tied up in that property. And so refinancing or going back to the bank to renegotiate your mortgage is the way that you can release that capital, and then you can use it to either grow your portfolio, do additional renovations, or do a lot of other things. And so again, like I said, I want to take you through some examples on the concept and how that works. Number one, let's take an average purchase in one of the greater cities that we work in today. It could be either Hamilton, Kitchener, Cambridge, Waterloo, anywhere in the Southern Ontario area. We're buying properties around the $600,000 to $700,000 mark. I'm going to use very even round numbers. There's going to be a lot of factors that aren't taken into consideration, like we're not talking about taxes, we're not talking about closing costs, stuff like that. I just want to keep it very high level. Okay, so say you're buying a property at $600,000. All right, so this is a very traditional investment property. We're going to the bank, and a traditional investor or a homeowner is going to have to put down 20% of this amount as a down payment. So 20% of $600,000 is $120,000. Okay, the rest of the money for that purchase is going to come from the bank. So the bank is going to loan us that 80%, which is $480,000. Okay, now this was our down payment, and this is the bank. The bank's going to usually loan us that money at a very reasonable interest rate, especially right now. We're looking at anywhere between 1.5% to 2%, and that's on the purchase side. So whether you hold that property for 5 years, or the other way to kind of speed up this whole process on the refinance is, and it has a nickname that a lot of people, you probably hear thrown around, it's called the BRRR strategy, which is buy, renovate, rent, refinance. So those are the steps that we're doing in order. And so this was been step one, which is the buy. So let's assume we're doing a pretty standard vanilla renovation, whether you convert it into a duplex or you just do a very nice single family renovation. Let's assume a renovation cost of about $100,000. Okay, so I want to make sure you're looking at all the numbers. So we've got $120,000, which we paid at the initial for a down payment. $100,000 is our rental cost. So our total is $220,000. Now, in today's market, by doing a renovation of $100,000, that's a really substantial renovation. Pretty sizable. It could be like brand new kitchens, brand new windows, doors, floors. Could be adding a basement suite, making it into a legal duplex, stuff like that. But by doing that, what we're doing is called forced appreciation, which means that this $600,000 value, we've done this nice renovation, it's all brand new, top of the line, modern, and the house is no longer worth $600,000. We've forced the value up by doing a renovation. And on doing about $100,000 worth of renovation, we're actually almost doubling the appreciation. So we're going, instead of starting at 6, adding 100, it's no longer worth $700,000. It's actually probably worth 8 in most of our solid markets. And the reason we do this is exactly for that, so we can force appreciation, so we can get some benefit for us being able to do the work, right? Because $100,000 renovation, it's a big reno, there's time involved, there's a lot of effort involved, you're managing your contractors. all that stuff. Plus you've got some carrying costs and whatever, so you need to make sure that this renovation is actually worth the money spent. So in scenario 2, the house is now worth $800,000. All right, so we've done our renovations, we've spent our money, and the house is now worth $800,000. We go back to the bank. This is kind of a side note, but you want to make sure that when you're doing the BRRRR strategy on a refinance, it's very important to work with the right mortgage broker to ensure that they know your goals going into the purchase. Because if you bought this house at $600,000 and you got a fixed rate mortgage and you do this renovation and it takes you 6 months, if you break the mortgage early, there's likely going to be a big penalty. But if you were to get a variable rate mortgage, the penalty is usually 3 months interest, which is anywhere from $1,500 to $2,000. So it's much lower penalty versus sometimes I've seen on a fixed rate mortgages penalties of $10,000, $20,000, $30,000. So side note again, but just when you're doing the initial purchase, make sure you're working with the right mortgage broker who understands what your end goals are. Okay? So then we go back to the bank or your mortgage broker and we say, okay, I want to refinance the property. It's now worth, we think, $800,000. Usually there's some sort of appraisal involved. The bank will go back, they'll send out an appraiser, they'll look at market comparables to determine what the new value is of the property. And assuming everything goes well, $800,000, bank agrees with you, then they'll say, okay, well, it's worth $800,000 now. We have to replicate this same percentage ratio when they figure out, okay, how much money are they going to lend you on this $800,000? Now, this has a lot to do with your own personal financial scenario. So again, working with the right mortgage broker is very important to understand what the implications are going to be. The other factor is, we're not talking about cash flow or anything in this scenario, but usually when the house is at $600,000, you have, say it's already a rental, you've got X number of dollars of rent. When you do the renovation, that rent will increase substantially, which will then also increase your ability to afford a bigger mortgage payment. Because as you'll see here, 20% down on $800,000, we're looking at $160,000. So this is the amount of equity that's left in the property. So originally you would put down 120, but by doing this reno, 160,000 has to stay in there. And then our new mortgage, again, this comes from the bank, they're going to give us $640,000, and that's our 80%. So this mortgage payment is obviously a lot more than this one. So you need to make sure that if this is going to stay as a rental, that you've got projected rents that are going to be high enough to cover those increased costs. Okay. Again, we're probably going to be sitting at that 1.5% to 2% in today's market, but even if it's as high as 3%, usually these rates will be supported. And so what happens is this $640,000, that's from the bank, it's going to go to you, but you got to remember, you've got to pay off your old mortgage first. So the bank says you take your 640 and you subtract your 480. Okay, so we're going to take the $640,000, you subtract it from the $480,000, and you're left with $160,000. And this is the amount that will actually get deposited into your bank account. Now, obviously, there's some fees and stuff that's associated with, but at a high level, this is how much is going to be left over. So remember, we spent $100,000 on our renovations. Now, this $120,000 is already factored into this calculation. So we're really looking at, okay, we spent an extra $100,000 out of pocket, but we have $100,000 in our bank account. So let's assume we're paying off that renovation cost, and we're actually left with $60,000 free and clear in your bank. And this is typically how an investor will go from one property to the next property to the next property. If the numbers and the forced appreciation is high enough, then this $60,000 on top of wherever else you've got capital available can then be rolled into property number 2. And now sometimes you might have to wait 2, 3, 4, 5 years before you can start taking advantage of doing this on multiple properties, but then those properties are able to be refinanced and those funds are able to help support the purchase of additional properties. Because as most of you know, it's very difficult for people to save up $120,000 just on your own. After all expenses and everything in today's market, trying to save an extra $120,000 is very difficult. So a lot of people will start with, where did this $120,000 come from in the first place? And oftentimes it's on their own primary residence. So maybe this $600,000 house isn't a rental that you bought. Maybe this is in your house. Maybe your house is worth more than this. Maybe you have a lot more than 20% equity in your property. And so then the bank will allow you to do a refinance on your own house to pull out that money. And once you've done this refinance, this number, if you haven't done a reno, is $160,000, and you can use that to go and purchase your first investment property. And now you've got two houses. And then 3 to 5 years later, you can look at doing the whole process again, assuming that the market's continuing to appreciate and that this rental property, the rents have gone up enough to substantiate the new increased mortgage prices. So as you can see, it's a very effective way to leverage your own property, the own equity that's in your properties, whether it's primary residence or whether it's an investment property, and enables you to buy additional properties. One of the other, a little bit different method, it's still a BRRRR strategy, and the ratios might be a little bit different. Instead of 20-80, it might be 20-40-60, is instead of getting a new mortgage, it's getting a home equity line of credit. And the reason why some people might choose to, even though you might be able to get less money from the bank on a home equity line of credit, just because their rules are a little bit tighter, when you, say this was your primary residence, and say you owned it initially 100% free and clear, the bank would let you take out 80% of it. If you borrow that $480,000 from the bank would say, okay, thank you very much, here's your $480,000, you've got a new mortgage, but it's your primary residence. You can't write off the interest on that mortgage payment. So say, I'm not sure exactly where it is, but say that $480,000 mortgage had a $1,500 a month mortgage payment. Normally that's broken into principal and interest, two pieces. And so say 50-50, it's probably not, it's gonna change over the life of the mortgage, but if it was principal and interest, principal is how much of that $480,000 you're paying back, and interest is that interest rate that goes back to the bank. On your primary residence, you can't actually write off this interest expense against your income. But if you were to take this $480,000 or a smaller amount as a line of credit, and you said to CRA, that line of credit is strictly going to be used for investing. Now, you have to put an asterisk here, make sure you talk to your accountant. But the way it typically works is that if you're using that line of credit just for investing, whether it's in real estate or other investments, this interest expense can now be written off against any income. So say you did borrow this money to buy this rental property, and say this rental property spit off $3,000 a month in rent, maybe even higher, and say after all expenses you're left with $800 a month of cash flow. This cash flow is money that's deposited into your account after all expenses are paid, and so it needs to be treated as income. And so you would normally pay tax on this at whatever your marginal tax rate is. So if you're making $800 and you don't have any write-offs, you're paying tax at this full pot. But if you borrowed the down payment from a HELOC and the interest is tax deductible, then say your interest expense was $200 a month, then that would come off of this $800 of cash flow, and then you would only have to pay tax on $600. So as you can see, some additional expenses that are related to your investment can be beneficial in reducing your tax burden. Again, make sure you're talking to your accountant, but typically that's the way it works. So in a nutshell, that's how refinances work. I hope this example was useful for you, and thanks for watching, and have a good one.